In the fourth quarter of 2025, a total US student loan debt hit an unfathomable $1.84 trillion. But the real crisis isn't 18-year-olds borrowing a few $1,000s for their undergraduate studies. It is a generation of 30-somethings waking up to the realization that they have been financially hobbled for life by $100,000 master's degrees that are essentially worthless. The most elite universities in the world have quietly transformed their graduate programs into cash cows. And they have done it while completely insulating themselves from the financial ruin of their own alumni. And today we lift the lid on the higher education sector and explain why the return on investment in human capital has completely collapsed. And we reveal how this government-backed debt trap is permanently destroying middle-class wealth forever. My name is Nick, and you're watching Coin Bureau Finance. For decades, the American middle class has been sold a very simple but outdated promise. Let's rewind to the 1980s and 1990s. Back then, the wage premium from an advanced degree was almost a mathematical certainty. Data from the Federal Reserve Bank of Cleveland showed that in the early 1990s, the college wage premium increased rapidly, with advanced degree earners seeing a 30% boost over those with only a bachelor's degree. You paid a reasonable sum for a master's degree, and the resulting bump in your salary easily outpaced the cost of the tuition. It was a reliable engine for middle-class mobility. But then, the universities realized they were sitting on a gold mine. Since 1980, college tuition and fees have skyrocketed by 1,200%. Now, to put that into perspective, the consumer price index for all other items has risen by only 236% over the exact same period. And graduate tuition specifically has grown at an even more aggressive pace. According to a landmark 2024 report from the Georgetown University Center on Education and the Workforce, the cost of a postgraduate degree in the US has more than tripled just since the year 2000. But there is a catch. While the cost of the credential was tripling, the actual economic value of the credential was flatlining. Data from the National Center for Education Statistics reveals that between 2012 and 2022, the real inflation-adjusted earnings for master's degree holders saw zero measurable growth. The premium has gone completely stagnant in real terms, while the costs have multiplied. And this is where the prestige illusion shatters. Elite universities recognized that they could not infinitely expand their undergraduate programs without destroying their exclusive brand appeal. Columbia University, for example, maintains a notoriously strict undergraduate acceptance rate of just 4%. But behind the scenes, they operate a secondary system. An investigation by the Wall Street Journal exposed that elite schools operate cash cow master's programs designed to purely generate revenue. Programs within Columbia's School of Professional Studies reportedly have acceptance rates exceeding 80%. They are charging between $82,000 and $84,000 in tuition for coursework-only programs that last just 10 to 18 months. And the profit margins on these programs are estimated to be between 60 and 70%. Now, for those who don't know, a cross-subsidy is when a business overcharges one group of customers to fund a loss-making venture elsewhere. And universities are remarkably open about this. Julie Kornfeld, Columbia's Vice Provost for Academic Programs, explicitly stated on the record that master's degrees can and should be revenue sources subsidizing other parts of the university. In plain English, they are taxing the ambition of the middle class to fund their administrative bloat and their PhD stipends. And the financial devastation for the students is absolute. Recent film program graduates of Columbia University who took out federal student loans had a median debt of $181,000. Yet, 2 years after earning their Ivy League master's degree, half of these borrowers were making less than $30,000 a year. They bought a luxury brand on credit, and the job market completely refused to reward the credential. But to truly grasp how catastrophic this debt trap is, we have to look at the raw break-even maths. Let's assume a student takes out about $100,000 in debt for a prestigious master's degree. In the 2025 to 2026 academic year, the interest rate on a federal grad plus loan is 8.94%. Over a standard 10-year repayment plan, that $100,000 principal will generate over $50,000 in interest. So, your total out-of-pocket cost is already $150,000. But we also have to factor in the opportunity cost of human capital. If you spend 2 years studying instead of working, you are giving up roughly $110,000 to $120,000 in after-tax foregone earnings based on median bachelor's degree salaries. Now, when you stack the tuition, the compound interest, and the foregone earnings, the true cost of that degree sits at an eye-watering $265,000. And to justify that massive deficit, your new master's degree needs to generate an additional $265,000 in lifetime earnings just to break even. At the current median wage premium of roughly $19,000 a year, you will be paying off that decision for nearly 14 years. And that assumes you even get a premium. According to a massive study by the Foundation for Research on Equal Opportunity, nearly half of all master's degree programs leave students financially worse off. 40% of master's degrees have absolutely zero net financial value. A master's degree in the arts or humanities has a median return of negative $400,000. Even the Masters of Business Administration, long considered the ultimate golden ticket, has a 39% failure rate where the returns are actually negative. The only exceptions are highly specialized STEM fields, computer science, and nursing. For everything else, getting a master's degree actually halves your median lifetime return on investment compared to just staying in the workforce with a bachelor's. And the opportunity cost is staggering. If you had taken that same $100,000 and invested it in a simple S&P 500 index fund 10 years ago, assuming historical returns of about 13% annualized, it would be worth nearly $340,000 today. And that is a $194,000 wealth gap between the prudent investor and the prestige-branded debtor. Now, avoiding macroeconomic traps like the higher education bubble requires you to see the data before the mainstream media reports on it. And that is exactly why you should subscribe to the free Coin Bureau weekly newsletter. Every week, we break down the hidden financial mechanics, the shifting labor markets, and the debt traps that are wiping out middle-class wealth. We give you actionable insights you need to protect your portfolio and make rational capital allocation decisions. And you can sign up right now by hitting the link in the description or by scanning this QR code on the screen. It costs you absolutely nothing, but in a market that is actively preying on outdated financial assumptions, it could save you everything. Okay, back to the video. Now I know what you're thinking. Why on earth would any rational financial institution lend $181,000 to a film student who statistically can only earn $30,000 a year? In a free market, they wouldn't. Private lenders assess the ability to repay before issuing a loan, which naturally limits how much malinvestment can occur. But roughly 91% of all outstanding student debt is held by the federal government, and the federal student loan system operates with virtually zero underwriting standards. Any student enrolled at least half-time can borrow money, regardless of their credit history, their assets, or the economic viability of their chosen degree. And for undergraduate students, the system is uniquely reckless. While undergraduate loans have strict borrowing caps, the federal Grad Plus loan program historically had no fixed limit on how much a graduate student could borrow. You could borrow up to the full university-defined cost of attendance, and this asymmetry explains a truly shocking statistic. While graduate students make up only 17% of total enrollment, they consume nearly half of all new federal lending. The government effectively handed elite universities a blank check, and the universities responded by endlessly inflating the cost of attendance. And this is known in economics as the Bennett hypothesis. When the government subsidizes low-interest or unlimited loans, it artificially increases demand, which allows institutions to raise prices without losing customers. But there is a darker layer to the system. The government is charging 8.94% interest on unsecured graduate loans. Now, to put that into perspective, that is higher than the interest rate on a 30-year secured home mortgage. The federal government is charging young adults more for education than commercial banks charge for real estate. And they enforce this debt collection through a legal mechanism that is almost impossible to escape. In 2005, the Bankruptcy Abuse Prevention and Consumer Protection Act expanded non-dischargeability rules to cover all student loans. Under current law, a debtor cannot discharge a student loan in bankruptcy unless they can prove an extreme undue hardship under the notoriously strict Brunner test. Between 2011 and 2019, less than 0.1% of applications made by student loan debtors in bankruptcy court were successful. Because the debt cannot be collateralized by a physical asset like a house, the collateral is legal coercion. And Wall Street has figured out exactly how to profit from this. Billions of dollars worth of student loans are packed and sold to institutional investors as student loan asset-backed securities, or SLABs. Corporations like Navient and Nelnet service the debt and then issue these securities in collaboration with major financial institutions like JP Morgan and Goldman Sachs. In total, over $600 billion worth of SLABs have been issued. Wall Street and the federal government have essentially securitized the ambitions of the middle class. They have turned the desire of upward mobility into a highly profitable, inescapable lifetime subscription of debt payments. And this brings us to the macroeconomic disaster that is currently unraveling. Because when you saddle 42.8 million Americans with $1.84 trillion in non-dischargeable debt, that money has to come from somewhere. The difference between what people owe and what life costs has to be extracted from the real economy. In September 2025, the Federal Reserve published a direct calculation of this exact phenomenon. They found that the resumption of student loan payments reduced consumer spending by $80 billion at an annual rate. And that is roughly 0.3% of the entire US gross domestic product, simply vaporized from the consumption economy. And when an entire cohort of highly educated 30-somethings are funneling $1,000 a month into debt service, they are not particularly in the broader economy. They aren't buying houses, they aren't starting businesses, and they aren't investing for retirement. Let's look at the housing market. As of the fourth quarter of 2025, the national home ownership rate for Americans under the age of 35 sits at a dismal 37.9%. Federal Reserve research shows that every $1,000 increase in student loan debt lowers the home ownership rate by 1.8 percentage points for college goers in their mid-20s. If you have $100,000 in graduate debt, your monthly payment of $1,200 completely destroys debt-to-income ratios. To afford a median-priced home in the US while carrying that much student debt, you would need an income of over $110,000 a year. And the US median household income is only $81,000 a year. And the maths completely locks them out of asset ownership. Meanwhile, the entrepreneurial engine of the country is also seizing up. A study from Gallup concluded that student debt led to 2 million fewer new businesses being formed over a single decade. Researchers at the Federal Reserve Bank of Philadelphia found that an 8% increase in total student loan debt levels in a given county leads to 70 fewer new small businesses in the exact same county. Potential entrepreneurs are so encumbered by student debt that they cannot secure the commercial loans they need to scale a business. And the retirement crisis is quietly compounding in the background. A recent data from Fidelity shows that retirement balances are roughly 30% lower among employees over age 50 who currently have student debt. Every dollar invested from a tax-advantaged 401k to service a student loan loses its entire compounding future. We have created a generation of indentured servants who are too indebted to take a chance on a new career, start a family, or invest in the markets. But the paradigm is finally beginning to shift. The market is a ruthless correcting mechanism and is finally beginning to reprice the value of these elite credentials. According to a 2025 research by the AI-powered hiring platform Test Gorilla, 53% of employers have now removed degree requirements entirely. Major corporations like Walmart, IBM, and Delta Airlines have dismantled degree barriers for high-paying corporate and technical roles. They are pivoting to skills-based hiring because the half-life of technical skills has dropped to just 2.5 years. A prestigious master's degree earned 5 years ago is increasingly being viewed as obsolete in an economy dominated by artificial intelligence. Even the stock market is delivering a brutal verdict on the education industrial complex. Look at Chegg, the academic help company that profited massively during the remote learning bubble. Chegg peaked at $115 a share in 2021. Today, it trades at roughly 62 cents, representing a 99.5% catastrophic collapse in value. Coursera, the massive online learning platform, is down 86% from its IPO price. And 2U Inc., the online program manager that helped universities scale their expensive digital master's degree, filed for bankruptcy. The smart money is fleeing the education sector because they realize the premium credential model has no viable future at current price levels. And even the federal government is finally being forced to admit a mistake. Under the One Big Beautiful Bill Act passed in July 2025, the government is officially eliminating the Unlimited Grad Plus loan program for new borrowers starting in July 2026. They are finally capping graduate loans because the default rates have become a systemic risk. As of the fourth quarter of 2025, nearly 10% of aggregate student debt was reported as 90 days delinquent or in default. The system is cracking under its own weight. So, if you're considering higher education today, you must view it as a strict, calculated financial position and no longer a guaranteed milestone of personal fulfillment. If the maths does not guarantee a return, you are not buying an education. You're buying a luxury brand you cannot afford, financed by a system that expects you to fail. The prestigious master's degree has transformed from an engine of middle-class mobility into a sophisticated wealth extraction mechanism. Unless you are entering a highly specialized STEM field or unless someone else is paying for it, buying prestige on credit is a guaranteed path to financial stagnation. You're better off going out and getting a job. But what do you think? Is higher education still worth the cost, or has it become a legalized scam targeting the middle class? Let us know your thoughts in the comments down below. And if you want to see how this ties into the broader consumer debt crisis, you can check out our video on that right over here. That's all from me today, though. Thank you guys very much for watching, and I'll see you again soon. Nick, over and out.